Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at houses, iron ore and DIY. All of these are capable of causing a fuss in the week ahead because on Monday the 15th of August we've got first half results from FTSE 250 house builder Bovis. On Tuesday the 16th, resources giant BHP Billiton will release full year figures, and Kingfisher will release a second quarter trading update on Thursday the 18th. So let's get going with those Bovis interims. The firm's going to be the latest house builder to publish its results, and a lot of the headline numbers though did come out in what was a pretty upbeat trading statement on the 7th of July, namely a 5% increase in new completions and a 15% jump in average selling prices. Now, note that those numbers meant that Bovis continued to see a bit of a slowdown in completions, but a re-acceleration of price growth based on this sequence in the full year figures for both metrics. Those numbers also left Bovis towards the bottom among its peers for volume growth for this period, but towards the top end for price increases, as the next graphic shows. Other numbers to watch for will go for the forward sales figure, which was dead on £2 billion at the full year stage, any margin expansion from last year's 17.3% return on sales, and the balance sheet, which has got minimal debt. And that last point is very important. Bovis doesn't have an expansive special dividend programme mapped out like, say, Persimmon or Barclay, but it has increased its shareholder payouts rapidly in the years after the financial crisis. Analysts are also calling for around a 5% increase in the dividend this year, enough to put the stock on a 5% plus yield. Now add that to a forward PE of barely 8, and income hunters in particular may be deciding to do some more research on the company, although that combination of low valuation and fat yield may just be the market's way of saying it doesn't really believe the analysts' forecasts. The share price slide suggests as much, so let's see what Chief Executive David Ritchie has to say on the 15th. Now the day after, Tuesday the 16th, we'll then get full year numbers from miner BHP Billiton. July's fourth quarter production update didn't go down that well, as the company missed production forecasts for iron ore output and guided down for oil and gas production from its US onshore businesses for the year that's just begun. At least capital investment in the oil business halved last year to $2.5 billion and will drop again this year to $1.4. Watch out for further news on cost cutting from boss Andrew Mackenzie, as a newfound cost and cash discipline has helped the shares to recover some lost ground this year after last year's brutal round of earnings downgrades and dividend cuts. Copper, coal, oil and iron ore are BHP Billiton's key products, and look at how iron ore in particular seems to influence the share price. Finally, spot of DIY to finish, not my strong point, since B&Q and Screwfix owner Kingfisher is due to release a second quarter update on Thursday the 18th. The shares have been all over the place since boss Véronique Laurie unveiled a 5-year transformation plan back in January, and the shares have been hindered since by fears that the EU referendum result could hit the economies of Britain and France, Kingfisher's two biggest markets. The stock market investors will be looking for an update on this 5-year plan, which includes work to simplify and harmonise product lines to help costs, expand the store footprint of Screwfix and drive the digital platform. The idea is to generate an extra £500 million profit uplift over 5 years, albeit with the benefits back-end loaded as Kingfisher makes some chunky upfront investments. The company is also targeting an additional £600 million of capital returns above and beyond its regular dividend payments for the next 3 years. That's equivalent to around 26p a share on a share price that's hovering around 350p as I sit here. Now remember, at the first quarter stage, sales rose 3.6% on a like-for-like constant currency basis, with the UK and Ireland and Poland doing well, the Castorama chain in France coming in flat, and Russia and Spain looking pretty weak. So let's see what Laurie has to say on those trends for the second quarter. Thank you for watching, and I look forward to seeing you next time.